Hello and welcome to another lesson on financial reporting, and today we'll look at an example on preparation of consolidated income statement and consolidated balance sheet. So in today's question, we'll look at April 2023 question 2. We'll look at April 2023 question 2. The question reads, River Limited operates in a fast-moving goods subsector. During the year ended 31st March 2023, River Limited expanded its operations by acquiring a controlling interest in SAI Limited and a significant influence over the activities of Tutu Limited. And the following draft financial statements for the year ended 31st March 2023 relate to the three companies. So just from that first paragraph there, we can tell that River Limited is the holding company and SAI Limited will be our subsidiary, whereas Tutu Limited will be our associate. So because a controlling interest will indicate you own more than 50%, whereas significant influence indicate that you own less than 50% but more than 20%. That makes it a subsidiary. So we have our statement of profit and loss for the year ended 31st March 2023. Our year is ending 31st March 2023. And we also have our statement of financial position as at 31st March 2023 for the three companies. We have additional information. Number one, on 1st July 2022, River Limited acquired 80% ordinary shareholding in SAI Limited for a cash consideration of 1.1100 million. The fair value of assets and liabilities of SAI Limited were equal to their carrying amounts at the date of acquisition. So just from that information, one thing you need to be keen on is the date. Remember, on 1st July 2022, this means that the company was acquired within the year and 80% makes SAI Limited a subsidiary. And 1100 million will be our purchase consideration. Number two, the group policy is to measure non-controlling interest at their proportionate share of net assets of the subsidiary at the date of acquisition. So that means that we will be valuing NCI at their proportionate share of net assets, and also means that we will calculate goodwill using the proportionate method. And number three, on 1st January 2023, River Limited acquired 40% ordinary share capital in Tutu Limited for a cash consideration of 500 million. So again, the date is very important. It seems that the company was acquired within the year. And I think that those are 3 months left in the year. And during the post-acquisition period, River Limited sold goods to SAI Limited for 300 million. River Limited reported a 20% margin on this sale, and half of these goods remained in the inventory of SAI Limited at the end of the year ending 31st March 2023. So from that information, we can tell that there is an intercompany sale of goods between River and SAI, which is a subsidiary. And we also have unrealized profit because the 20% margin that River made on those goods, half of those goods still remained in SAI Limited at the end of the year. So that will give us our unrealized profit. Number 5, included in the trade receivables of River Limited was 80 million due from SAI. In the books of SAI Limited, the amount due to River was shown as 60 million. because Sai had remitted 20 million, but River had not recorded the remittance. So we have intercompany debts, where we have River owing 80 million, or Sai owing 80 million to River, but again, River Limited has already sent 20 million, and this 20 million has not yet been reflected in the books of River. So we need to eliminate that on our balance sheet, on the trade receivables, and also on the trade payables. On 1st October 2022, River Limited sold an assembly plant in Sai Limited for 400 million, reporting a profit of 25% margin on the selling price, and netted off the profit against the cost of sales. So this is affecting the cost of sales. Again, we have an intercompany sale of fixed assets, where River is selling to Sai. Okay. The group charges depreciation on plant at the rate of 20% per annum on cost on full year basis, and none in the year of disposal. That's okay. Impairment tests carried out on 31st March 2023 revealed that neither the goodwill on acquisition nor investment in associate had been impaired during the year. And lastly, number 8, none of the group companies paid dividends during the year to 31st March 2023. You are required to prepare a statement of profit and loss for the year ended 31st March 2022, given 8 marks, and a consolidated statement of financial position as at 31st March 2023, given 12 marks. So let's go right ahead and do those 2 questions. And remember, this is April 2023, question 2. April 2023, question 2. So we can start by preparing our income statement. So we have River Group. Consolidated income statement. For the year ended 31st March 2023. So we know the format. We start with the revenue, and in this case we have shillings in millions. So we start with the revenue, and in this case revenue, again we need to be very keen on the date when the subsidiary was acquired, especially when you are consolidating the income statement, because we need to split the revenues or the incomes and expenses if it was acquired within the year, because the holding company is not entitled to the incomes if it was not there when those incomes were being earned. So to do that, we need to get the date when the subsidiary was acquired, and I saw we had acquired this subsidiary in between the year. So let's do our workings on the side here. So working 1, you can prepare the group structure. So let's go to additional information number 1. If you want to get the past papers, check out the link on the description where you will be directed to the website and download the past papers. So on additional information number 1, we are told on 1st July 2022, River Limited acquired 80% of Sai Limited. So we have the group structure will be River Limited acquiring 80% in Sai Limited and 40% in Tattoo Limited. So the purchase consideration was 1,100 million, and this was not acquired. This was not acquired at the end or at the beginning of the year. It was acquired in the middle of the year. So we need to calculate how many months between July 2022, 1st July 2022 and 31st March 2023. Those are 6 months. Let me see. We have July. Those are 6 months. 6 months to December and another 3 months to 31st March 2023. So plus 3. So plus 3 months. So we have a total of 9 months. So this company was in the group for 9 months. This company was in the group for 9 months. So we have 9 here, and also this one was 3 since it was on January to March. So that is 3 months. So once we have that, then we can go ahead and prepare our income statement. So the revenue in this case was 4190 for the holding company plus 2600 times 6/12 minus the intercompany sales of 300. So this is giving me 5840. So remember, this should not be 6/12 but 9/12. 9/12. Now we go to the cost of sales. A few items are affecting cost of sales. We have depreciation on the sold plant, on the plant that was sold, and also the profit that was made on that plant, and also we have unrealized profit on closing stock, and also we also have the intercompany sales, because the sales of one company is the purchases of the other company. So we have 2730 for the holding company plus 1400 times 9/12 for the subsidiary times 9/12. Then we minus 300 the intercompany sales. So we need to calculate the unrealized profit on closing stock. The unrealized profit on closing stock. So that information, we have it on additional information number 4, where we are told during the post-acquisition period, River Limited sold goods to Sai for 300 and River Limited reported a 20% margin on this sale. Half of these goods remained unsold. So margin is based on the selling price, so there is no need to convert. So we will take 20%. So this is working number 2, unrealized profit. So unrealized, we will take 20% margin. If it was markup, we could have converted into margin by adding the numerator to the denominator, but since it's margin, so we take 20% of 300, and remember half of these goods remained unsold, so our unrealized profit will give us 30, because this is 60 divided by 2 giving us 30. So we go ahead and we add back, we add back 30 there. Another item is the intercompany sale of fixed assets. So that information, we have it on additional information number 6. So additional information number 6 reads that on 1st October 2022, River Limited sold an item of plant to SAI for 400 million, reporting a 25% margin on the selling price, and netted off the profit against its cost of sale. So we need to get 25% of 400, and then we net it off against the cost of sales. So we have 400 times 25%. That is giving us 100. 25% of is giving us 100. So we can have a working here. Working 3. Profit on sale of plant. We have 25% of 400. This is giving us 100. So 100, we need to include it here. And we will take plus 100. Okay. Again, we have depreciation on the plant. We have depreciation on that plant we need to calculate and eliminate it. So since they sold that plant at a profit, it means that depreciation was overcharged. So we will take 20% of the 100, get the overcharge in depreciation. So we have working number 4, depreciation overcharge. Since we sold that plant at a profit, means that we overcharge depreciation. So we will take 20%, which is the rate of depreciation, times 100. I know we acquired this plant at the end of the year, but in the middle of the year, but on the same information we are told that number 6, the group charges depreciation on the plant at the rate of 20% per annum on full year basis. So we will not need to apportion the depreciation. So 20% of this will give us 20. So that is the depreciation overcharge. Again, we less it here. Minus 20. And I don't think there's anything else. So we can go ahead and get the total here. And the total is giving me 35.90. We can get the gross profit. And the gross profit in this case will be 22.50. 22.50. So let's go ahead and check whether we have other incomes. And from the income statement, we have investment income, but it seems to be down below, so we need to get the profit on operations first. So let's go ahead and add the less the expenses. So less the expenses, we have distribution costs, expenses. So on expenses we have distribution costs. So distribution costs we have 300 plus 200 times 9/12. This is giving me 450. Less. Next we have administrative expenses. Administrative expenses we have 500 plus 400 times 9/12. So this is giving me 800. And next we can get the operating profit. The operating profit is giving me 2250 minus 450 minus 800, 1000. So you can go ahead and add investment income. I'm just taking the figures from the income statement. We have 40 plus 20 times 9/12. So 40 plus that is giving me 55. Next we have finance cost. Finance cost we take 80 plus 60 times 9/12, and that is giving us 125. Get the profit before tax. The profit before tax is giving me 930. Then we less tax. Tax we will take let's go back to our income statement, and you'll realize that the income tax expense, we will take 180 plus 160 times 9/12, and this is giving me 300. So the profit after tax is giving me 630. Now we go ahead and add share of profit after tax from the associate. We add share of profit after tax from associate. So this one will take 40%. The profit, if you look at the income statement, the associate had a profit of 200 from the income statement of the associate, which is Tutu Limited. They had a profit of 200. Now our share, since we acquired 40%, will be 40% of 200. But then again, we did not acquire the associate at the end of the year. It was in between the year, and we had only had 3 months left. So we will take 40% times 200 times 3/12. This is giving us 20. So we have the total profit. Total profit is 650. Now this 650, the profit attributable to the parent, we can less NCI share so that we get the profit attributable to the parent, because this is the entire profit. Now we less NCI share of profit after tax. So we less NCI share of profit after tax. We less NCI share of profit after tax. So since we acquired 80%, then the NCI will be 20%. The profit of the subsidiary was 400. If you go back to the income statement, you will see that the profit for the subsidiary was 400. So times 400 times 400. Now we need to check whether there are any upstream transactions that are affecting the profit of the subsidiary. And let's look at this additional information number 6. River Limited sold an assembly plant, so that is downstream. It's not affecting the subsidiary. Let's check another one. Included in the but even before we go there, on the same point of number 6, on 1st October 2022, River Limited sold an item of plant to Sai. Now Sai bought this plant, but they overcharged depreciation since they bought it at a profit. So that depreciation overcharge is affecting the profit of the subsidiary. So saying that the NCI share of profit after tax will be 20% of 400, that 400 is actually overstated, and we will need to adjust it. We will need to adjust it. It's actually understated, not overstated, because they overcharged. It's actually understated. So we'll need to add to adjust that one. So we will take for 20% of 400 times 9/12, because the NCI was only the holding company only acquired the subsidiary for 9 months within the year, and then we need to add back the 20. We need to add back the 20 because it was understated. So we add back the 20 from there. So we will have 20% of 400 times 9 over 12 plus 20. So this is giving me 64. So 64. So if I less 64, I get the profit attributable to the parent. Profit attributable to the parent. Profit attributable to the parent, which is 586. It is 586. So that is how we do an income statement. Now let's go ahead and attempt the balance sheet. Let's go ahead and attempt the balance sheet. So we have River Group, Consolidated Statement of Financial Position, Statement of Financial Position, as at 31st March 2023. Now we start with the assets. So up on the assets, we start with non-current assets. On the non-current assets, we have PPE. And on PPE, we will take 2070 plus 1290. So we had the item of plant that was sold. So we less the 100, the intercompany sale of plant, and the depreciation of a charge we need also. And a charge we also need to add it. The depreciation and a charge will also need to add it there. So PPE will give us 3280. So again, we need to calculate the goodwill and the investment in associate. The goodwill and the investment in associate. So let's do our working here on the side for the balance sheet. So working number 1, we have goodwill. And from the additional information, we saw that goodwill will be using the proportionate method. And that was information number 2. The group policy is to measure and controlling interest at the proportionate share of net assets of subsidiary at the date of acquisition. So again, we'll need to take that into account. So we have the purchase consideration. We are not using the full method, purchase consideration. The purchase consideration we are given in additional information number 1. As on 1st July 2022, River Limited acquired 80% of the ordinary shares in Sai Limited for a cash consideration of 1100 million. So we can have shillings in millions. So we have 1100, and then we less the net assets acquired. Net assets acquired. We less the net assets acquired. And in this one, let's take the ordinary share capital. We can take them in full and then split them. I'll take the group share once we finish the workings at the bottom. So we have Ordinary share capital, we have it as 500. We also have share premium. Share premium, we have it as 200. We also have pre-acquisition retained earnings. Pre-acquisition retained earnings. Pre-acquisition retained earnings. So we get the pre-acquisition retained earnings from our income statement, and we are told that let me see, on additional information number, well, it's not actually in the additional information, but we have it on the balance sheet. If you look at the balance sheet for the associate, we have retained earnings at 800. So that 800 reflects the accumulated retained earnings. And to get and we also have the retained earnings for the year. We also have the retained earnings for the year given in the income statement of Sai Limited as 400, given as 400. Now, to get our pre-acquisition retained earnings, we will take 800 minus 400, and this since the company was not acquired for the full year, times 9 over 12. So that will give us our pre-acquisition retained earnings. So this is giving us 800 minus 4. This is giving me 500. So we get 1200. And since we are using the proportionate method, we multiply by 80%. We get 1200, 80%, 960. This is giving me 960. So if we take 1100 minus 960, I'm getting a goodwill of 140. So goodwill is 140. So now you can go ahead and calculate the investment in associate. So we take the cost of investment. And cost of investment in this case is given as we are given in additional information number. Number 3, we are told on 1st January 2023, River Limited acquired 40% of Tutu for a cash consideration of 500. So the consideration was 500. That will give us the cost of investment is 500. And then we add share of post-acquisition retained earnings. We add share of post-acquisition retained earnings, and post-acquisition retained earnings after acquisition, we will take the retained earnings for the year given in the income statement, which are 200, times it was acquired only for 3 months. So our post will be 3 over 12. But we need only our share. Our share is 40%. So 40% of that, 40% of 200 times 3 over 12, and that is giving me 20. So our investment in associate will be 520. Will be 520. 520. 520. So we have that, and I don't think we have anything else. In non-current assets, we go straight to current assets. Current assets. And our current assets, we are given inventory, so inventory we take 530 plus the subsidiary 390 minus the unrealized profit of 30, we get 890. We go to receivables. We take the holding company 640, the subsidiary 470, minus the intercompany debt of 80. This is giving me 1030. We take the financial assets. The financial assets, we have 300 plus 150 . There is no other adjustment. We get 450. We go ahead and take the cash and bank balance. Cash and bank balance, we take, let me go back, we have 360 plus 200 plus 200. We also have cash in transit from additional information number, from additional information number. Let me see. It was additional information number 5. We have included in the trade receivables is 80 million due from SAI, and in the books of SAI Limited, the amount due to River was shown as 60. And SAI Limited had remitted 20 million. So that 20 million is not recorded, so we will need to include it there. So we have 360 plus 200 plus 20, we have it as 580. Okay, let's proceed. We have equity and liabilities. So for equity, we only take the holding company's equity, and we have ordinary share capital, ordinary share capital is 2500. We have share premium, is given as 500. We have retained earnings, and we also have non-controlling interest. We'll have to do some workings for those. And then from there we have non-current liabilities. I usually encourage students just to get the most direct entries, especially on the balance sheet, first. So we have a loan note. And loan note will take 640 plus 480. 640 plus 480 giving me 1120. We also have deferred tax. Deferred tax, we have 260 plus 100. It's giving me 350. You also have current liabilities. Have trade payables. We'll take 420 plus the subsidiary 330, but since 20 had already been paid, we will not eliminate the entire 80, we'll just eliminate the 60, and this is giving me 690. Then we have current tax. Current tax, we have 160 plus 90. So let me know in the comment section, and if you want to see the workings for the non-controlling interest and the retained earnings. And that concludes our income statement and our balance sheet.